Guys, welcome to the Crypto Academy YouTube channel. I'm Wolves of Crypto. This is, of course, Mega well. You'd know us both by now. We've decided to start a YouTube channel for Crypto Academy, especially just for collaborative videos. And I suppose I'll start off by saying we're going to be discussing not so much direct TA, but we're going to take certain topics that maybe you guys as a community might recommend to us in the comment section below and just throw some ideas between us. Do you want to tell them what we're starting off with here today, Whale?
Yeah, so today, guys, we're going to be focusing on the difference between being a trader and an investor. And when we're talking briefly between myself and Wolf, I guess our opinions on that. So, Wolf, you had a poll that you posted a couple of days ago, wasn't it, in your YouTube community, asking how many people are traders, how many people are investors, percentage-wise?
Yeah, so I'll bring up the poll just so you guys can see it here. Let me just scroll down and find it. We had a poll, and I'll share my screen in my community. I was interested to see how many people in my community consider themselves a trader or consider themselves an investor. Now, just quickly, just to give you a definition of what that is. There's no objective definition, I don't think, at least, between being an investor or being a trader. I'd say you'd be an investor if you hold positions generally for more than a few months. You'd be a trader if you're or a swing trader, at least if you're holding for within a month, a few weeks, days, intraday. That's trading. I think it's pretty clear to someone on an individual level whether they consider themselves a trader or investor. But I asked the question because I think, Whale, you'd agree, we're both traders. Now, I discuss generally more long-term stuff on my channel. I also dive into short-term, but you primarily dive into short-term. So I suppose my channel might attract a little bit more investors than traders. 75% of people on my channel said that they were mostly investors, while only 25% of people said they're mostly traders. Just off the bat, what are your thoughts on that as a result of the poll? Do you find that interesting or...
Well, I think it goes back to a few things. First and foremost, it's definitely easier to associate yourself as an investor, particularly if you're new to the space. Being a trader seems almost daunting, seems a little challenging, seems difficult, maybe a little bit foreign to most people. So I feel like off the bat, people who are generally a little bit newer to trade or newer to financial markets will kind of migrate towards the investing spectrum. I don't know if maybe that makes sense to you. That's definitely what I've experienced in my time in this market. Generally, with new people, they tend to migrate to safety, and sometimes purchasing things on a whim, dropping accountability for that, and leaving it for X amount of time can sometimes sit better with those individuals, and they consider themselves traders, investors. So I think there's a big difference between an investor and a trader. And really, realistically, the difference is what I would define it is. An investor is someone who is willing to purchase an asset and hold the asset for a larger time frame or an extended time horizon until they turn an eventual profit on which they'll sell that asset. Where a trader is someone who's willing to jump in and out of the market repeatedly, maybe many times a day, or even just once a day, depending on what type of trading you're doing, whether it's swing trading or scalp trading, in hopes of not winning every trade they take, but in hopes of turning an overall profit. Whereas an investor, they're mainly focusing on winning every single trade they take. They want every investment they make to be a profitable investment. As a trader, it's more of a numbers game. You're not going to win every trade you take. It's not possible. But as a whole, after 3 months, 6 months, 9 months, a year, a collective amount of trades, you're looking to turn a profit.
Correct.
So that's kind of my opinion on the difference. Like I said, I think the majority of people do align themselves with being investors. I think it's a safer position to put yourself in because like we've all talked about, I definitely think being a trader takes a lot more knowledge, a lot more skill, a lot more time in the market. You need screen time in the market to understand price action. And, really to trade effectively, it's a difficult game. I think they've said 98%, 96% of people who trade in the markets actually lose money. And,
yes,
that goes for itself. That's a pretty significant bit of data.
Yeah, it's definitely got a learning curve. I suppose the follow-up question, the follow-up topic in that is that do we think that people should strive to be traders? Is there a person out there, I know a lot of people, for example, obviously have, 9-to-5 jobs, don't have a lot of time, might have kids, wife, whatever, and they might not have time to be an intraday trader, for example. I still think that, there is a difference between being an investor and being a blind investor. I think a lot of people would consider themselves investors, but in reality, they just chuck money blindly into Bitcoin because they think it sounds good or they might vaguely understand the fundamentals. I think that even if you're an investor, you have an obligation to understand TA to a certain level so that you're not a gambler. Right? I think there is a difference between a trader and an investor and a gambler. I think honestly, a trader would be the most knowledgeable in the market because they need that knowledge in order to fully succeed in trading charts. Investors probably second most knowledgeable, and a gambler's third most knowledgeable. And I think, honestly, in order of how much people profit in the market, I think it'd go in the same order. I think that if you're a trader, you're most likely making more money than an investor. An investor's making more money than a gambler. So it's very important, even if you consider yourself a very busy person. I'm not saying you have to be an intraday trader. I'm just saying that if you want to be an investor, you need to understand that being an investor and studying the charts, etc., to be an investor is going to make you less money than being a trader. If you're studying the charts. So are you willing to accept that? Are you willing to accept the fact that, hey, okay, I don't have the time, so I'm going to be an investor instead, knowing that you're probably going to make less money than a trader would? Because, Bitcoin, for example, cyclical theory, 4-year cycle, Bitcoin right now is at the same price level as that in 2020. If you're an investor and you're strictly long-term investing, you're even on your investment in 2 years. If you were a trader, you would have taken advantage of all that upside opportunity. So I don't know about you, but I would encourage even people who consider themselves investors to understand TA so they can make good buying and selling, not just holding the whole way through like maybe a gambler would do, I suppose.
Well, that's correct too. And there's a multitude of reasons why TA is important, but then you have to come back to the fact that a lot of investors aren't complete investors. What I mean by that is a lot of people will invest and say they're investors, but on the side, they're throwing $100 at shit coins. They're jumping onto Dogecoin pumps. They're FOMOing in and out of trades. So then are you actually an investor? Or are you an emotional trader and you're investing as a coping mechanism to reduce your accountability for your intraday decisions? Okay, because a lot of people will say, oh, I'm putting my money here. I'm just going to hope it goes to the moon and I don't care how long it takes and I'm just going to hold it. And then they go down 80% and then they decide, you know what, I'm selling. So are they actually investors? You have to ask them, am I actually investing in this asset or am I just gambling on a larger time frame? And that's something that people need to obviously decide for themselves. But, as you said before, that little, ladder from, being a trader, being an investor, being a gambler in terms of profits, you're looking at traders. There's more variables. There's more things that can go wrong when you're trading in terms of not only, short-term decisions. If you're making a lot of decisions, it's more likely you're going to be wrong more often, right? If you make 100 decisions a day, you're probably going to be more wrong more often than if you make one decision a day, right? So comparing a trader to an investor. But for example, as a trader, one of the biggest roadblocks to your profits, which we'll get into maybe today, maybe another day, is emotions. Emotions will directly impact your profits as a trader, where as an investor, it doesn't really make a difference because the moment you decide to invest, you already have that time frame that you're willing to invest in. So you're kind of taking that accountability, you're taking that emotions out of it. You don't really care what's happening at the price action until then it's down 80%. And then you're like, oh shit, I've lost 80% of my investment. Now you're emotional. Now you panic sell. Yeah. So I guess, look, I don't think being an investor is bad.
No.
I don't think being only a trader is bad. I think it completely is determined on a few things. Number one, your understanding of the markets. Obviously, like you said, if you understand TA, if you understand price action, if you understand how to trade more effectively, you've got a good trading strategy that you developed over a couple of years, you should be a trader. You'll make more money trading and investing, okay? If you're an individual who you don't have good emotional control, you don't have good impulse control, you maybe don't have a lot of time on your hands, maybe then you can look at going into swing trading, maybe a few days to a few weeks, or even a few weeks to a few months, or maybe you can look at investing. And if you've got a lot, a large time horizon, you're not interested in making money in the immediate future, you're interested in building wealth over a large time frame, and you want to set aside some capital to that, then investing is a great opportunity. But I think in the cryptocurrency market, to call yourself an investor, I don't see, I really don't see a lot of actual investors in cryptocurrency. And I would say you probably agree, there's a lot of people who are taking long-term swing trades, but I don't see a lot of real investors, particularly in the retail, at least.
There's not much to invest in. Everything in crypto is incredibly new. Aside from Bitcoin, maybe Ethereum, most altcoins you hear about on a daily basis were made in like 2020. So, there's not much to invest in just straight off the bat. But I would say as well, just to add to this conversation, is like, you don't have to put yourself in a box. As a trader, I've got investments. So as an investor, you can have trades as well. You don't have to strictly put yourself in a category. It's just what you'd consider yourself, I suppose, most likely to do, because the charts, generally speaking, TA works on all time frames. The 1 minute chart is going to be analyzed in a very similar way than the daily chart. The candlesticks, they don't lie. The patterns still play out the same to a relatively similar probability. So realistically, if you know TA, you shouldn't have any real problem other than the emotional problem and the time problem of converting from being an investor to a trader and from a trader to investor. Now, look, I don't know about you, but I've spoken about on my channel a couple of times, just kind of moving into a different topic here, about DCA'ing. And I've spoken about it in quite a dangerous way. I don't necessarily agree with DCA'ing because I think the whole premise of DCA'ing encourages blind investing and gambling to a certain extent. If you look at people like, I'm not going to call out any names, but you guys know who I'm talking about. Throughout the entirety of the bull market, and throughout all the hype, they kept posting over and over again, if you bought this much Bitcoin every week for this many years, and it encourages a bad mindset. The fact of the matter is, you probably shouldn't, in my opinion at least, be buying Bitcoin every week, regardless of the price. We're not even looking at the chart. It's dumb. It doesn't make sense. If you have the time to do that, and if you have the time to fundamentally understand Bitcoin, which you should have the time to do, if you're doing that, you have the time to look at charts once a week before you buy. What are your thoughts on DCA'ing?
Well, this is a thing, right? Because what you said in my mind makes perfect sense. But we have to understand as well, like me and you, we're traders. All right. I'm a very short-term trader. I'm a scalp trader. I trade a very small time frame. You're a little bit larger time frame trader. But we already have a bias towards what we think is the best thing to do based on our results.
Yep.
For example, we've come in the market, we've learned a certain variety of skill sets, we developed those skill sets, we've put those skill sets into practice, we've attained good results, and therefore we think that is the best way to go because we're the living proof of those results. So I haven't never used dollar cost averaging, and therefore for me to say that it's necessarily a bad thing is probably a little bit biased. I wouldn't go as far to say it's bad, but I would go as far to say that it can be abused and used incorrectly, just like anything, right? You can use any tool can be used incorrectly. Like, for example, a lot of people will say leverage trading is ridiculously stupid, but it's only stupid if you do it incorrectly. And I think that kind of goes the same with dollar cost averaging. I think dollar cost averaging, if used correctly and appropriately, can actually result in you making decent profits. But if used incorrectly and inappropriately, you can end up in a pretty bad position because it does, whether or not dollar cost averaging works or not, it heavily relies on the premise that at some point this asset class is going to turn around and go to profit.
Yep.
Sometimes assets don't turn around and go to profit. They keep going down, they keep going down, they keep going down. You've invested all the way down and it never turns back up. It does happen. So for you to say, oh, if I just dollar cost forever, it'll eventually go back up, that's on a very big assumption that that asset will actually rise again. Now with Bitcoin, sure, a little safer, like it most likely will go up. But if you're looking like an altcoin, like you're going to go invest in Solana from $260 all the way down, all the way down, all the way down, all the way down, and then it just goes to zero or goes very close to it and never goes back up to 260. Did dollar cost averaging work? Was it a good idea? So I think,
by the way, which is very possible, happened with Luna. So just saying.
I'm not going to say, I'm not by no means am I saying Solana is going to zero. I've got no opinion on that right now. But I think at the same time, guys, dollar cost averaging is there is no strategy in trading that is a free win. There is no singular thing you can do that can guarantee you profits on any time horizon, any strategy whatsoever. And I think dollar cost averaging should be viewed the same way. There's a strategy in which you can implement, and if you implement it correctly at the correct time, it can be beneficial. But if you don't, it can obviously get you wrecked.
Yeah, and my buying plan on Bitcoin is a good example. I mean, my buying plan on Bitcoin, which I suppose a decent amount of you would be familiar with, just a quick premise, I'm basically buying at certain levels as the price go downwards, right? So technically that's dollar cost averaging. But I suppose the main difference that I'm trying to make here is that that's an educated version of dollar cost averaging based on the charts, based on support levels, based on time frames. I think, the main quarrel I have with dollar cost averaging is, again, it encourages the blind. I'm going to buy every week regardless of the price. I don't think that's healthy. I don't think that's good. Now, we did want to talk about Amazon because Amazon's one that I did a video on yesterday. Relatively controversial topic. Because there are a lot of people in the space who stand by the fact that, and this is where I'll start it out. I premise it with this: the reason why Amazon, you guys might have noticed this, the reason why Amazon is commonly compared to Bitcoin is because Amazon was a big part of the the dot-com bubble in what, 2000, somewhere around there, right? And people compare that
even earlier.
Even earlier, right? So people compare that to cryptocurrency because they kind of make that comparison. Oh, the crypto bubble, the dot-com bubble, same thing, both technology, I suppose. So they take the comparison and they often use Amazon as kind of a reference here because Amazon looks a lot, supposedly, I'll bring up the chart right now, looks a lot like what Bitcoin looks like, right? So this is Amazon here from 1998 through to like 2001, 2002. And this is Bitcoin on the side, both weekly charts. You can see the similarities. There are similarities, of course. You know, we've got a double top formation on Bitcoin, double top formation on Amazon. Amazon notably went down, and this is where the predictions come into play. So this is what people would say who trust this fractal. Amazon went down 94%, and it took around 658 days. Now, if Bitcoin was to do that, it would go down to around 3 or 4K, roughly, and it'd get there in around August to September 2023. All right, so straight off the bat, what do you think about the Amazon fractal?
So, you know, I've talked about the Amazon fractal before. I talked about it back in January of this year, 2022. And I think it's a tricky one because I personally hate fractals. I really don't like fractals whatsoever. And the reason I don't like fractals is because you can realistically take any move that we've seen historically, expand it, or even not expand it, and apply it to a chart, and you can see similarities across multitudes of different charts. And the reason being is because, number one, different asset classes are correlated to a certain degree of correlation. So we're always going to see similar price action. Number two, prices move between supports and resistances in similar market structures. So no matter what chart you're looking at, you're always going to have a degree of similarity between charts. So when you say a fractal is going to work out, again, it's nothing but speculative. There's nothing really there's no data really holding it actually to that, in my opinion.
Yep.
Now, what do I think about the Amazon price prediction? I think it's like 4K, 3K or something.
4K, September 2023, yep.
So as traders, right, and even as investors, whoever invested on this channel, and you know, all we can go off is historical data. You know, it's all we can go off as traders. We use historical price action to basically help us determine what the next lot of price action is going to be. That's what we do when we do short-term analysis. That's what you do when you use technicals. That's what you do when you do structural analysis, whatever type of analysis you're doing, you need historical data. So when you're looking at the price action here, and particularly when you infer the 4-year cycle on it with that negative 48 or 84% drawbacks on the 4-year cycle.
Correct. Oh, of the 4-year cycle, 84, yep.
84. So this is suggesting, you know, a 10% greater drawdown than the 4-year cycle. So go with the 4-year cycle. I'm not even saying the 4-year cycle is going to hold up, because eventually we should see either a break lower or we should see a diminishing, which is less than what we've seen in the prior cycles. Because again, we have to factor in something called the displacement of money effect. And what the displacement of money effect is, if you take a $1 trillion market cap and it reduces 84% in value, the amount of money displaced from that market in comparison to a $100 million market cap reducing 84% in value is significantly greater, right? So if you take into the fact, if you factor in the displacement of money effect, markets eventually, the higher the market goes in terms of total market capitalization, the smaller and smaller those pullbacks are going to be in terms of ROI, in terms of percentage pullbacks on the broader spectrum. So the diminishing return model is essentially based off the premise of the displacement of money affected markets. Why do I think it's very unlikely we go down to a 3K, 4K level? First and foremost, that what I just said there, the displacement of money effect, the amount of money that would need to drain out of the markets for us to reach that level will be absolutely catastrophic on our historical levels. Yeah. So even if we go to like 3,000 Bitcoin, no one's going to be celebrating at that level. I'm not going to be happy at 3,000. We have eliminated like 5-6 year long horizontal support levels when we reach that level. I know you won't be. I know anyone with their right mind will not be happy if Bitcoin goes down to 3K.
And they wouldn't be buying either, that's for sure.
They wouldn't be buying. I wouldn't buy at 3K. I wouldn't. We've eliminated basically all the major horizontal levels we developed throughout the entirety of 2015, 16, 16, 17, 18, 19, 20, you know?
Yeah, correct.
So look, could we go down there? You know, who the hell knows, really? Who the hell knows? Is there data to suggest we're going there? No, there's not. Is there data to suggest we're going to bounce well before we go to 3K? Absolutely. There is so much data. There is volume chunks greater than any volume chunk we've seen on the Bitcoin chart in history at around 12, 13, 14, at around 12, 11, 9, 10K. So for us to even imagine 3K, we have to get through a chunk of support spanning about $4,000 or $5,000. That chunk of support is the biggest chunk of support on the Bitcoin chart in terms of the history of Bitcoin. So for us to go down below there would require something so catastrophic to occur, either in the global financial markets or the cryptocurrency market itself, that the consequence of that effect would be so devastating on cryptocurrency that even if we went down to 3K, it wouldn't freaking matter, because we're going to be in such a shit position. And that's my opinion. Like, why would I'm not even going to bother talking about something so potentially far away. Look at the price now. What's the price of Bitcoin? 16,000 right now? 16,200. Let's take a look at my chart over here. 16,200. For us to go down to $3,000 based on a fractal, which is basically a whim. Okay, a fractal is an 81% drop from here, guys. I'm not saying it's not going to happen, but I'm saying it's very unlikely we make this move down before we find significant supports, before we bounce. Like, we're not just going to bleed out. Here's another thing. If we take a look at something really important too, which is the top 100 Bitcoin addresses, which a lot of those are dormant, a lot of those exchange addresses with reserves.
I'll bring that up right now, actually.
I did a calculation on my channel, but if you take up the top 10 wallet addresses, they account currently at the current price, they account for 10% of the Bitcoin's price. Okay, they account for 10% of Bitcoin's price. So they're holding the price over around $1,600 alone, and that is only the top 10 wallet addresses. If you expand it to the top 100 wallet addresses, that's holding the Bitcoin price over $3,000, over $4,000, over $5,000. Okay, you have to keep in mind, a lot of these addresses are dormant addresses. A lot of these addresses haven't been touched for years. A lot of these addresses are exchange addresses. And that's 7.29% of the Bitcoin addresses. So less than 10% of the Bitcoin addresses are holding the price over $3,000 right now.
Well, there you go. Look at this. The top 9% of the Bitcoin addresses hold 98% of the Bitcoin. So there's the great example for you. And also, you got to take into account, as you said, lost Bitcoin. There's been a certain amount of Bitcoin over there. I don't know how much it is exactly that's been lost. That inherently kind of raises the floor as well. Yeah, I just go back to what you said. Like, what would have to happen for Bitcoin to go to 3K? There would have to be an absolute catastrophe. And on top of that, what would have to happen for Bitcoin to go to 3K by August 2023, which is very soon? Another 81% drop by August 2023. That's not a long time, right, in terms of macro scale. An 81% drop in less than a year, that's not a long time at all. So, yeah, I'd consider the Amazon Fractal basically fictional. And to be honest with you, if I'm being completely honest, I don't see the similarity. I think people are over-exaggerating how striking the similarity between these two charts are, even if fractals were reliable in the first place. These charts really don't look too similar. The only similarity is the fact that they double-topped. And guess what? This is what double-tops look like. Just because Amazon did it 20 years ago, it doesn't mean we're following Amazon. It just means we're doing TA. That's just what TA is, what TA does. That's what double-tops look like. So, I think it's fictional. Yeah, I don't know. That's my opinion on it. A lot of people would give backlash on that, but I think this is the typical phase of we're very, very close to the bottom now, I think, and in terms of time and potentially in terms of price as well. And this is where we start seeing these ultra bearish assumptions come out, just like we saw the ultra bullish assumptions come out towards the top. I see this as no different. This is not the first time, and this is something I went over in yesterday's video on my channel, which you can check out if you want. This is not the first time we've seen people suggest Amazon is the same as Bitcoin. We saw the exact same thing here in 2018 as well. Not the first time Amazon's been used. It's been used as a comparison to Bitcoin since the inception of Bitcoin, basically. So, yeah, that's my opinion on that. Now, yeah, we're I don't know. I don't know if you want to end the video there. We've got.
Well, I think I'll expand on it a little bit.
Yeah,
and
sure.
I think this is the thing about market structures, because market structures, they do have a set of principles and, I would say, definitive rules in which to define the structure itself. For example, right, let's take a descending wedge. You absolutely need at least 3 clear retests of a downward trending resistance and at least a minimum of 2 clear retests of that lower downward trending support, and obviously it's converging. So you need key data points on structures to actually confirm the fact that these structures exist. I feel like a lot of people, when they're looking for fractals, when they're looking for structures, and this goes hand in hand, fractals and structures, they try rather fit the structure to a price action rather than allowing the price action to tell you what the structure is. What I mean by that is they look at the price action, they have a cognitive bias to where they want the price to go, and then they try mix and match, and they try shape and fit structures that I would say that, what's the word, that help
support that theory.
Support, yeah, that's the word. I've lost my words. Support that directional bias. And I see it all the time. I see it all the time. People applying head and shoulder patterns, people applying certain different horizontal channels, wedges, whatever, to support their bias when those structures don't even actually exist there. They look similar. They look like they could fit, but they don't actually reach those confirmations. Again, it's to support biases. So when you look at something like this, you're like, okay, is this really a fractal, or is this just a normal downtrend?
Yeah.
Is this really a fractal, or is this actually just a normal macro downtrend? And
Correct.
if I'm going to go on a whim over here, if someone thinks it's a fractal, why? Why is this fractal? Give me actual data. Tell me exactly why this fractal is a fractal, and tell me why it's the Bitcoin price action, and tell me why I'm wrong by saying, no, it's just a normal downtrend, because you can't answer that question, right? And if you can't answer that question, you can't objectively say that this prediction is held up on data and correct. Because as we already know, as we defined before, any sort of future price prediction is based on historical price action. So I guess that statement there just blows up the argument that this fractal is legit, because, well, I just explained it. What do you think, Wolf?
Yeah, no, completely agree. Completely agree. There needs to be a basis, but it needs to be more in depth than, oh, they look similar. Because as we both just said, market patterns look similar. That's what market patterns are. Doesn't mean they're copying each other. Just means it's the same market pattern. So yeah, look, that's pretty much the Amazon fractal debunked there. So yeah, I don't know.
And look, it could freaking go down to 3K. Like it could, right? But the fractal is not going to be the thing that's going to tell us it's going to go down there, right? Exactly. If it happens, it's going to be caused by some random news event, some random catastrophic shit that happens in the market that's going to blow it up. But it's not going to be like, oh, guys, the Amazon fractal from 1998, man, that predicted it. No, it's not going to do it. It's not going to do it. And, you know, like, we're not going to name anyone, but there's a particular guy who thinks he's the god of the Amazon fractal. But we have to remember, this guy's like, oh, call the top, man. But guess what? This guy was calling top of 20K, 30K, 40K, 50K, 60K. If you call the top every day, eventually you're going to be correct to call it the top.
Exactly.
Same shit, guys. So look, all I'm going to end it on, and I'll let you end it as in a second or two, is, you know, when you're doing analysis, if you can't back up what you're saying with factual data that is absent of emotion and opinion, you don't have anything. You don't have anything. And it doesn't matter how long you've been in a market. It doesn't matter how many years of experience you have. You can spend 30 years in a market and be losing for 30 years and say you have 30 years of experience. It doesn't matter. What matters is your mindset and your analytical style. That's what matters the most, I think. But, you know, this is a channel we're going to be spending a lot of time on. We'll probably do, 2 videos a week?
2 videos a week, Monday, Friday, most likely, start of the week, end of the week. It works best for traditional markets. This is the channel. Welcome. I will say before we end, obviously it's the Crypto Academy channel, so it'd be a bit of a weird thing to me to end it without talking about the Crypto Academy. Crypto Academy is, as you can see on the website right now, a course developed and created and owned, operated by myself and Whale. Become a trader, 10-unit course. We created this start of the year, released it in May, and it's been doing very well ever since. How many students do we have now? Let me check. 83 students roughly as of last month, as of the start of the month, I should say. And we haven't had any complaints at this point. In fact, we've had nothing but positive words to say about it from our students. And so if you're interested in that, check out the website. All the information's on the website, and you can throw us an email at cryptoacademycourses@gmail.com. Another thing I would like to say, you guys are familiar with BitGet. It's both of our exchanges. We use the exchange for trading. We work together quite closely. And so we've determined both separately and collaboratively, but this is the superior exchange to use for trading. We're going to get a Crypto Academy link for you guys to sign up there, so you can help out both of us at the same time if you don't want to pick between us. But for now, you're going to have to pick between us. So it's either myself or Whale. Sign up using our referral link if you want to support the channel and you want to get on a good exchange. I think we'll end the video there. Thanks for watching. Hope you enjoyed, and we'll catch you in the next one.